Did you know that in May 2026, inflation is still actively shrinking the value of your savings? Leaving your emergency fund in a standard bank account is like watching your money slowly disappear. This video will show you exactly how to protect your cash and start earning more by exploring high-yield savings accounts and CDs. If this information helps you make smarter money moves, consider subscribing for weekly financial insights. What's your biggest question about managing your savings? Let us know in the comments. Let's talk about where your money is sitting right now. Imagine inflation as a slow leak in a tire. Even if you've got a good amount of air in there, it's gradually deflating. In May 2026, that's precisely what's happening to cash in traditional savings accounts. According to the Bureau of Labor Statistics, inflation remains a significant concern, meaning your purchasing power is declining daily. We're going to explore smarter places for your money to live. Places that actively fight back against this silent wealth drain. The economic forecast for 2026 suggests interest rates may be approaching their zenith. This presents a unique and potentially fleeting opportunity for those holding cash, especially for emergency funds or short-term savings. Allowing this capital to languish in a standard checking or savings account means it's actively losing purchasing power, a phenomenon exacerbated by persistent inflation. For instance, if inflation hovers around 3%, money sitting idle effectively depreciates by that much annually. Consider this. The average American household holds a significant portion of their liquid assets in traditional accounts. What if there was a way to protect that money from inflation's erosion and even grow it substantially? High-yield savings accounts, or HYSAs, are emerging as a compelling solution. As of May 2026, leading online institutions are offering APYs that far outpace traditional banks, often in the range of 4.5% to 5.25%. This is akin to finding a premium parking spot for cash that would otherwise be left exposed to the elements. However, the landscape also includes certificates of deposit, or CDs. These offer a fixed rate for a set term, typically ranging from 6 months to 5 years. While they may offer slightly higher rates than HYSAs for longer terms, they come with the trade-off of reduced liquidity, meaning access to the funds is restricted until maturity. Choosing between these options hinges on individual needs. Is immediate access paramount, like for a readily available emergency fund? Or is the priority to secure a higher, guaranteed return for funds not needed in the near future, perhaps for a down payment plan for 2 years from now? Understanding this balance is key to making an informed decision that aligns with financial objectives and the current interest rate environment. Parking hard-earned cash in a traditional savings account today is akin to leaving money on the table. With inflation a persistent concern in 2026, even a small amount of money can lose purchasing power over time. Consider this. If inflation hovers around 3%, $1,000 today will only buy what $970 could buy last year. Fortunately, a powerful tool exists for making savings work harder, the high-yield savings account, or HYSA. What exactly is a HYSA? It functions much like a standard savings account, offering a safe place to store funds. The key differentiator lies in its significantly higher annual percentage yield, or APY. While a typical brick-and-mortar bank might offer an APY of 0.05%, HYSAs, often found with certificates of deposit, often called CDs, offer a distinct path to predictable earnings, especially when current interest rates are favorable. Unlike a standard savings account where rates can fluctuate, a CD allows an individual to lock in a specific interest rate for a predetermined term, such as 6 months, 1 year, or even longer. This fixed nature provides a significant advantage in an environment where interest rates might be at their peak, as predicted for May 2026. Think of a CD like pre-ordering a popular concert ticket at a set price. The price is fixed, and the certainty of that price is valuable. Similarly, by opening a CD, one secures a known return on their savings for the chosen duration. This predictability is a key differentiator. For instance, a 1-year CD opened today might offer a guaranteed annual percentage yield, APY, of 5.25%, according to industry analyses of May 2026 rates. This locked-in rate means that even if market interest rates were to fall in the coming months, the yield on that CD remains unaffected. This stability is particularly appealing for funds that are not immediately needed, such as a portion of an emergency fund or savings earmarked for a specific future purchase, like a down payment on a home. But what happens if an unexpected expense arises before the CD matures? The fundamental difference between a high-yield savings account, or HYSA, and a certificate of deposit, or CD, boils down to a trade-off: access versus a guaranteed return. An HYSA offers flexibility, allowing funds to be withdrawn anytime without penalty. Think of it like a readily available checking account, but one that pays a much higher interest rate. Conversely, a CD requires money to be deposited for a fixed term, say 6 months or a year, in exchange for a set interest rate that won't fluctuate. This locking in of a rate provides certainty. Consider this. If interest rates were to rise significantly after opening a CD, the holder would be stuck earning the lower locked-in rate. On the other hand, an HYSA's rate can adjust with market changes. For instance, as of May 2026, the national average for a traditional savings account hovers around a mere 0.10% according to the FDIC. In contrast, top online banks are currently offering HYSAs with annual percentage yields, or APYs, upwards of 4.50%. This disparity is crucial when planning for short-term goals, like a down payment for a home or building an emergency fund. While a CD might seem appealing for its guaranteed rate, its lack of liquidity could be a problem if funds are needed unexpectedly. But what if those funds are truly not needed for a set period, and securing a higher fixed return is the priority? That's precisely where the certainty of a CD shines. Safeguarding one's financial assets is a foundational element of financial well-being. A key component of this protection involves understanding how institutions safeguard customer deposits. This is where the Federal Deposit Insurance Corporation, or FDIC, plays a crucial role. When a bank or credit union is FDIC-insured, it means that deposits are protected up to a specified limit. This insurance acts as a safety net, ensuring that individuals do not lose their savings if an insured institution were to fail. Consider it like a guarantee on your money, provided by the U.S. government. What exactly does this protection entail? Currently, the standard deposit insurance amount covers up to $250,000 per depositor, per insured bank, for each account ownership category. This means if a person has multiple accounts at the same insured bank, their total coverage could exceed $250,000, depending on how those accounts are structured. How can one verify if an institution is indeed FDIC-insured? It's a straightforward process. A quick check on the FDIC's website, specifically their Bank Find suite, allows anyone to search for an institution and confirm its insured status. This verification is essential for peace of mind. Did you know that as of 2024, the FDIC insures over $11 trillion in deposits across thousands of financial institutions? This staggering figure underscores the widespread trust and reliance placed upon this vital protection system. Knowing your money is secure frees up mental energy to focus on growing those funds. Opening a high-yield savings account or certificate of deposit online is a remarkably simple and secure process. The first step typically involves gathering a few key pieces of information. This usually includes personal identification, like a social security number, a valid government-issued ID, and proof of address. Think of it like preparing for a quick digital handshake. The bank needs to verify identity to protect everyone involved. Once that's ready, the online application itself is designed for efficiency. Many institutions have streamlined these forms, often taking less than 10 minutes to complete. So what happens after the application is submitted? The crucial next step is funding the new account. This is usually accomplished through an electronic funds transfer, often referred to as an ACH transfer, from an existing checking or savings account. This method is highly secure and is a standard practice for financial institutions. For example, the Federal Reserve reported that in 2023, over 70% of all electronic payments were ACH transactions, highlighting their widespread adoption and reliability. Are there any limits to how much can be transferred? Generally, there are daily or monthly limits set by both the sending and receiving institutions, but these are typically generous enough for most initial deposits. This straightforward process ensures that making your money work harder is within easy reach, without unnecessary hurdles. A common oversight for many is leaving emergency funds or short-term savings in standard checking or savings accounts. Consider this. If inflation hovers around 3%, as projected by the Congressional Budget Office in recent analyses, cash sitting idly in a low-yield account is effectively losing purchasing power. What's the alternative? High-yield savings accounts, or HYSAs, and certificates of deposit, or CDs, offer compelling options in May 2026. For instance, in early May 2026, leading online banks are offering HYSA rates that can reach upwards of 5.00% annual percentage yield, APY. This is a significant jump from the typical 0.1% APY seen in traditional savings accounts. But what exactly is a HYSA? Think of it as a regular savings account, but supercharged. It provides easy access to funds, much like a checking account, while offering a much more attractive interest rate. This makes it ideal for those needing flexibility, like an emergency fund. Conversely, certificates of deposit, or CDs, involve locking in funds for a predetermined period, such as 6 months or a year, in exchange for a fixed interest rate. For example, a 12-month CD might offer a competitive 5.25% APY. This predictability can be appealing for specific savings goals, like a down payment on a home within a year. However, a crucial pitfall to avoid with CDs is early withdrawal. This often incurs a penalty, effectively erasing some or all of the earned interest. It's akin to breaking a fixed-price contract. There's usually a consequence. Understanding this trade-off between liquidity and a potentially higher locked-in rate is key to maximizing returns.